Introduction to Cost Accounting. Introduction to the module. Cost accounting is the backbone of financial insight, providing businesses with a clear understanding of where money goes in production and operations. By breaking down every expense into categories, from fixed and variable to semi-variable costs, cost accounting offers a granular view that drives strategic decisions. This discipline equips managers to track, control, and optimize costs to support growth and ensure financial stability. In this module, we'll cover the foundational elements of cost accounting, including its purposes and role in making informed business decisions. Topics such as cost types, key accounting terminology, and cost allocation will provide a comprehensive understanding of how businesses analyze and manage expenses. Learning objectives. At the end of this module, learners will be able to explain the purpose and scope of cost accounting in business contexts, identify and distinguish between fixed, variable, and semi-variable costs, define key terminology related to cost accounting for effective interpretation, describe the role of cost allocation in improving budgeting and planning, analyze how cost accounting aids in decision-making and strategic planning. Basics of cost accounting. Cost accounting is a branch of accounting that focuses on capturing a company's total costs of production by assessing both variable and fixed costs. It involves the tracking, recording, and analysis of costs associated with manufacturing goods or providing services. The primary objective of cost accounting is to provide detailed information that helps management make informed business decisions regarding budgeting, pricing, and operational efficiency. Key components of cost accounting include cost classification. Costs are categorized into direct costs, for example, raw materials, direct labor, and indirect costs, for example, utilities, administrative expenses, to better understand where resources are allocated. Cost measurement. This involves determining the actual costs incurred during production or service delivery, allowing businesses to analyze performance accurately. Cost control. By monitoring and analyzing costs, organizations can identify inefficiencies, set budgets, and implement cost-saving measures. Decision support. Cost accounting provides essential data for decision-making, including pricing strategies, product line profitability, and financial forecasting. Performance evaluation. Regular cost reports enable management to evaluate the efficiency of operations and assess whether the business is meeting its financial objectives. Key terminology in cost accounting. Cost accounting employs specific terminology that helps categorize and understand various expenses within an organization. Familiarity with these terms is crucial for interpreting cost reports accurately and making informed decisions. Key terms include fixed costs. These are expenses that remain constant regardless of production levels, such as rent and salaries. They do not fluctuate with the volume of goods produced. Variable costs. These costs vary directly with production levels. Examples include raw materials and direct labor, which increase or decrease based on the amount produced. Semi-variable costs. Also known as mixed costs, these have both fixed and variable components. For instance, a utility bill may have a fixed base charge, plus additional costs that vary with usage. Overhead. This term refers to all indirect costs associated with manufacturing that are not directly tied to production, such as utilities, maintenance, and administrative expenses. Direct costs. These expenses can be directly attributed to a specific product or service, such as materials and labor used in production. Indirect costs. Unlike direct costs, these are not directly linked to a specific product, but are necessary for overall operations, such as management salaries and office supplies. Cost allocation. This process involves distributing indirect costs across different departments, products, or projects to accurately reflect the total cost incurred. Cost accounting versus financial accounting. Cost accounting and financial accounting serve distinct purposes within a business, each playing a crucial role in financial management. Purpose. Cost accounting focuses on internal reporting to assist managers in making informed decisions regarding cost control, efficiency, and budgeting. Financial accounting, primarily concerned with producing financial statements, such as the income statement and balance sheet, for external stakeholders, including investors, creditors, and regulators. Reporting. Cost accounting provides detailed insights into specific activities, such as production costs and labor expenses, which directly affect day-to-day operations. Financial accounting summarizes the overall financial position of the organization, presenting a comprehensive view of financial performance over a specific period. Regulations. Cost accounting, more flexible and tailored to meet the internal needs of the business, allowing for adjustments based on management requirements. Financial accounting must comply with standard regulations and accounting principles, ensuring transparency and consistency for external reporting. Users. Cost accounting, primarily used by internal management to drive operational decisions and enhance efficiency. Financial accounting, utilized by external parties, including shareholders, regulators, and financial analysts, to assess the financial health of the organization. Types of costs: fixed, variable, and semi-variable. Costs in a business are classified as fixed, variable, or semi-variable based on how they change with production levels. Fixed costs, such as rent, remain constant regardless of production volume. Variable costs, like raw materials, fluctuate directly with the level of production, increasing as output rises. Semi-variable costs, such as utility bills, have both fixed and variable components, changing partially with production activity. Categorizing costs in this way helps businesses understand expense behaviors and create accurate budgets. By identifying which costs change with output, companies can better forecast expenses and improve cost control, making decisions that support financial efficiency and operational stability. Fixed costs. Fixed costs, such as rent, insurance premiums, and salaries, remain constant regardless of production or sales volume. They offer stability in budgeting, but can put financial pressure on businesses during low activity periods. Understanding fixed costs helps companies determine their break-even point and profitability threshold. Accurately identifying fixed costs allows managers to make informed pricing and budgeting decisions, supporting long-term financial sustainability and setting stable cost baselines for financial planning. Variable costs. Variable costs, such as raw materials, direct labor, and production supplies, fluctuate based on production or sales levels. They are easier to adjust than fixed costs, providing flexibility in budgeting. Understanding these costs helps businesses control expenses during production shifts, respond to market demand efficiently, and make informed pricing decisions. Efficient variable cost management supports cost control strategies, allowing businesses to adapt and remain competitive. Semi-variable costs. Semi-variable costs have both fixed and variable components, making them partially responsive to changes in production levels. Utility bills are a common example, with a fixed base charge and an additional charge that varies based on usage. Semi-variable costs provide flexibility, as they allow businesses to manage expenses, with some control over variable portions. During periods of high production, these costs can increase, but during low production, they reduce, providing some relief to the budget. Properly managing semi-variable costs helps businesses optimize resource usage, as it allows for controlled spending without sacrificing operational efficiency. Recognizing these costs aids in creating adaptable budgets that respond to fluctuating demand. The role of cost accounting in decision-making. Cost accounting provides essential insights that drive effective business decisions on expenses, production efficiency, and profitability. Managers leverage this information to set pricing, identify cost-saving opportunities, and allocate resources efficiently. For instance, analyzing material and labor costs can reveal production inefficiencies, prompting adjustments that reduce expenses. Cost accounting also supports budgeting and forecasting, helping companies set realistic financial targets and monitor progress. With a detailed operational view, businesses can align decisions with strategic goals and optimize financial outcomes. The role of cost accounting in decision-making therefore includes pricing strategy, development. Cost accounting provides detailed data on production costs, helping managers set competitive and profitable prices. Identifying cost-saving opportunities. By analyzing expenses in materials, labor, and overheads, cost accounting reveals inefficiencies and potential areas for reducing costs. Resource allocation optimization. Insight into cost structures enables better resource distribution across departments, improving operational efficiency. Budgeting and forecasting. Cost data informs realistic budgeting, allowing businesses to set financial targets and monitor performance over time. Profitability analysis. Cost accounting aids in determining which products, services, or projects are most profitable, supporting prioritized investment and development. Supporting strategic planning. Detailed cost insights allow businesses to align operational decisions with long-term goals, ensuring sustainable growth and financial health. Cost allocation and its importance. Cost allocation involves distributing expenses across different departments, projects, or products, allowing businesses to understand the true cost of each activity. Accurate cost assignment helps companies determine product or service profitability and make informed pricing decisions. For instance, production costs may be allocated to individual product lines, revealing which items contribute most to profitability. Effective cost allocation also supports budgeting, as managers can see where resources are being used and make adjustments as needed. This process promotes transparency, ensuring that each department or project reflects its actual expenses. Accurate cost allocation aids in overall financial planning, enhancing accountability and decision-making within an organization. The importance of cost allocation includes enhances profitability. Analysis. Allocating costs accurately to products or services helps identify which are most profitable, guiding business focus and investment. Supports informed pricing. Understanding the true cost of each product or service, companies can set pricing strategies that reflect actual expenses and competitive margins. Improves budgeting accuracy. Cost allocation reveals precise resource usage across departments, enabling managers to adjust budgets based on actual needs. Increases financial transparency. Allocating costs ensures that each department or project reflects its real expenses, promoting financial clarity across the organization. Facilitates accountability. Clear cost allocation allows departments to take responsibility for their expenses, fostering a culture of accountability. Aids in strategic planning. Accurate cost distribution provides data for informed resource planning, aligning departmental activities with overall business goals. Highlights of the module. Cost accounting provides a detailed breakdown of expenses, enabling businesses to make informed decisions on budgeting, pricing, and cost-saving opportunities. Understanding the types of costs, fixed, variable, and semi-variable, helps businesses predict expense behaviors and optimize financial planning. Cost allocation assigns expenses to departments or projects, improving transparency and allowing managers to assess each unit's profitability. Effective cost allocation aids in setting realistic budgets and enhancing financial accountability across an organization. By dissecting each cost factor, businesses can identify inefficiencies and redirect resources for greater productivity and profitability. Thank you. You have successfully made it to the end of this module.